Welcome to TradeTheMBI.com. This is Jonas. Reports for the 17th. Well, after our fill of the positive extremes, nothing but rosiness going up. We've had this little bit of a rotation as we've been seeing some of the pro-Trump configurations starting to take a little bit stronger heat, which means they've been improving. And that's just markets betting on directions of how things will go. I imagine we'll probably see more of the same of that after the Fox interview with Harris, but none of that really seems to make that much of a difference as we get closer to a couple weeks left. But from an overall reading standpoint, you can clearly see magenta above that 33 level here, so clearly in the upswing of things. Shorts, MBI white fading off completely, hasn't quite dipped below the negative 10, so there's still some activity there, but any bounce back would be a little bit more interesting at these upper levels. But if we dip all the way back down below the negative 10, then it's just going to be softness. This is all coming off of the shakeout with the rising gold started it, and it was just a matter of waiting for that blowout. We had the one brief positive extreme, but it filled back immediately, so not much of a factor from that standpoint. All the headwinds and everything that we've talked about for the last many months still exist, but of course that's all covered over with the election situation taking place. And even from an NQ, though, you can see the lagging reality of it relative to what the S&P is doing. And some of that's just the muted view of where consumers are headed, and particularly when you're tech heavy with the NASDAQ, consumers definitely make a significant impact on it. From a treasury standpoint, we're still in a relative no man's land. Again, this still, even at these rates, still forces everyone into the market for a yield given where the rising inflation. And it's built into the scenario, so it really becomes difficult. The Fed can cut all it wants into it. The market's going to have to respond, because what do you want a treasury for at lower yields? It makes no sense whatsoever. Complete ignorance of basic economic terms, but then there is the reality of the credit situation, and that is the underlying problem underneath things that nobody really talks about. And it's significant because you've got a lot of arbitrage and a lot of derivatives, and it really, the way they're positioned, most of these banks in that are underwater with a lot of their assets, and just because of accounting changes, they allowed them to alter it. But they've been purchasing treasuries nonstop, and by lowering rates, at least the newer ones that they bought help even out the older that they've been holding on to, and so that kind of mitigates the losses that they're seeing. At least they can convert them from paper losses to more net neutral. And I imagine that's the Fed's goal, is to try and help them out with that over time. But it has a negative impact from an inflationary standpoint, but that will take time to play out. From an oil standpoint, a bit of a retracement going back from that standpoint here, and that's fine. It's sort of in the middle of the road. It's not going to take much of whether it's an Israeli response to Iran that has any impact on oil. You still have the Russian elements. These are all things that are known unknowns, simply because you just don't know how there's going to be a change from where things are currently. ECB is about to issue some of its guidelines going forward, and the Euro's in just a disaster mode at this particular stage. So the whole EU economy has just been pretty much out of whack for quite a while, and it's just because of the policies that they employ. And at the end of the day, you've completely returned all the way back all the positive extremes that we had, going back to the beginning, which was right here. And fine, but it lays a broader problem for going forward. Any downturn is just going to result in higher deficits and higher spending, which is more devaluation, and their rate's going to start to increase faster than the U.S. even. So there's just the global economics at play when we look at it from a gold standpoint. As I've, and I'm not, never have been a gold bug per se, but this has been an obvious trade from several years ago when this all began as an unprecedented move, starting with COVID. They were able to contain it for a while, but you have every central bank around the world trying to buy gold quietly, publicly, whichever way. Same with crypto. And now you're seeing the explosion. Of course, this would be what some people might consider the Trump trade, in that he has promised, buying of Bitcoin and holding on to it from a government standpoint, and that's been back and forth. Looking at a Harris or Biden situation, there's been pressure on cryptocurrency things, but you have the exact opposite view from Trump view. So, but regardless of that, it is still an inflationary play. So secondarily, it has to rise from that standpoint alone, simply because it keeps you out of the devaluating currency situation. ETH likewise hasn't quite broken past its, and if once they get past these resistance areas, then I think you're starting to see some significant moves. From a 50K standpoint, it was pretty straightforward. We had our positive extreme retrace. Sell signal came in with the breakdown of the magenta yellow going below, and then we had the rise of MBI white, and that stayed pretty clear until we got midpoint here of the crossover of blue back over gray, right under the 50%. So they made it pretty easy. Anything back above the 50%, you start to look for long situations. But you kept having the shorts riding, and this becomes one of those where we talked about, you ride the short push in there, and it just accelerates the need to cover, and we get the continued push up throughout, and that's exactly what we've seen with this one. Pretty stable. I don't see anything overly dramatic from a market reaction standpoint. These are all pretty standardized trades. You're still getting the same up push, fighting back and forth between the calls and put situation, and then you get the reverberation back post market. And that's what you see, the next day line right there. You filled it all back here in the European session. And depending on how sad the European ECB situation is, that could have a broader impact. We're seeing a nice little bounce back in the pre-announcement era, and we'll see how it goes after that. I'm not sure what they're going to be able to say, because you're not going to affect growth dramatically in their situation by changing rates. This particular point, that sort of has a diminishing return, and I think the Fed has finally recognized that one as well. And it becomes a problem because you've built in an inflationary system within the Federal Reserve concept, and all you're doing is just adding fuel to already burnt wood, and that's not producing as much fire as you might hope it would. That's kind of the best analogy for that one. As always, though, anything relevant, I'll put on the Skype chat. Have a good one. Trade well.